We're taking a look at the currency market now with Nomvuyo Guma, macroeconomic strategist over at Standard Bank. Nomvuyo, I can say that the tweet that we did receive from a viewer this morning causing quite a stir in the studio already. We've had a viewer write in saying that he sees the rand hitting 9.50 by the end of this year, then strengthening to about 8 rand next year. But beyond the first quarter, that rand moving to 14 against the US dollar. What did you make of that kind of forecast that's come through from a CNBC viewer?
My initial reaction, Alishia, is that he must be in the exporting business and holding thumbs for the kind of depreciation in the rand that he's seeing there.
Well, let's take a look at your views then on the local currency. We saw some short-term reprieve filtered through to the local unit on Friday. It's sitting on shaky ground at this stage of the game where we know that things are pretty uncertain over in the Eurozone.
Absolutely, Alishia, but for this week in particular, we think that the local data coming out, because there's so much of it and because it's quite important local data, the rand could take more direction this week from local fundamentals rather than developments overseas. But of course, those still remain quite key to the rand's movements, and so barring any flare-up in the Eurozone or US, then the rand would be able to take direction more from fundamentals this week than what we've seen in previous weeks.
When it comes to those fundamentals, full focus on Q3 GDP data, which is being anticipated tomorrow. Run us through your forecast on that end, because we've got a market that's broadly expecting a quarter-on-quarter rise of between 1.8 and 1.9%.
Well, we saw the economy lose significant amount of momentum in the second quarter. It sort of slumped from growth rate of 4.4% in the first quarter, then down to about 1.3 in the second quarter. So we're seeing a bit of a revival in quarter three, but very modest. We've penciled in growth of about 1.6% quarter on quarter for quarter three, based largely on the high frequency numbers that we've seen coming out. The big decline that we saw in quarter two was largely related to drags on growth that emanated from the primary sector of the economy. So that would be mining and agriculture, and all indications are that those two sectors continue to struggle in quarter three, and you can even add the manufacturing sector to that. So we see quite a bleak growth outlook for the third quarter of this year.
With that being the case on the one hand, and of course on the other, we saw those inflation numbers come through last week. We've got CPI sitting at 6%. We had strong retail sales filtering through and showing some recovery, at least in the consumer side of the economy. And we've got rates on the FRAs having or expecting a hike in interest rates moving forward. Have you changed your forecasts in that regard?
No, we haven't changed our forecast, Alishia. We still see rates remaining on hold, and that's really based on the two things that you've outlined there. So firstly, we're seeing inflation ratchet up quite alarmingly. In fact, for November, we're expecting it to have breached the upper limit of the target band, and then it's likely to stay outside the target band for most of 2012. We only see it returning on a sustained basis in quarter four. So that really is going to leave the Reserve Bank in quite a difficult place, because should GDP growth numbers then come in the region in which we've penciled them in, or even lower, then they're really going to find themselves in quite a difficult situation, because we're going to have a situation with very high inflation combined with very low growth. And in the instance, we think that they're likely to keep interest rates on hold based on the inflation outlook, but then the weak GDP outlook is going to prevent them from being able to raise rates, certainly very early in the year next year.
Well, we wait keenly for those data points to filter through this week. Of course, GDP data just being one of those figures. We're anticipating trade numbers, credit numbers, and also vehicle sales and PMI numbers locally this week. So it's a busy data week. Let's get your view on the crosses, Nomvuyo. I mean, the euro getting swept high in thin trade this morning. It was struck by a wave of short covering, it seems, rising as high as 133. Some market players, however, skeptical that these gains are going to last much longer.
We're also skeptical, but we look at it much more from a fundamental basis. And if you just look at the underlying fundamentals of Europe, the reason it's been the reason it's been gaining or rallying against other countries, we think, is largely due to the optimism that we saw earlier that things in the Eurozone should settle down with the ushering in of new governments in that region. But looking forward, we think that the problems in the Eurozone are still structural, and until the leaders in that area realize that and begin to tackle the underlying structural issues in the the Eurozone. We don't think that the support for the currency is going to remain. So over the medium term, we still see that going down as far as 120 against the dollar, although we can't discount the possibilities that there will be brief rallies in between. But our long-term, medium-term view is still bearish, and so we definitely don't see this rally as being sustainable.